we're more concerned about what the Fed plans to do with its balance sheet, right? We're actually expecting them to announce some sort of a schedule or path for reducing balance sheets by first, cutting down on reinvestment. I think that's going to probably have a bit more impact on the overall liquidity situation in the U.S. and possibly globally. So that's something we're following closely on. Yeah.
Indeed, I think a lot of people would agree with you. This when they start actually touching the balance sheet, that's when it really starts to matter. When do you think they're going to start signaling that, Ken, and when do you actually expect the action to happen, starting first with stopping reinvestment?
I would probably think. I think we're by the end of the year we'll probably get close to a more concrete signal, and the action will probably start to take place next year. This is all, of course, built on the assumption that the economic expansion continues, and maybe we get a little bit more oomph from the fiscal side, which is not particularly promising at the moment.
Indeed, I mean it's not even there; it's not visible.
Right.
That's one of the things that people want a lot more clarity about. So, as and when they start doing that, tinkering with the balance sheet and first stopping the reinvestment and then slowly starting to shrink it or taper it, does that mean that they can afford to be less aggressive and do fewer and smaller rate hikes?
Well, I think the two aren't mutually exclusive, right? So I think the path of rate hikes, well, according to FOMC, is we're probably going to get to 3% by the end of 2019. Now, that kind of path would require a pretty perfect path for the economy as well. I think the market right now is somewhat lower than that. So I think my view is closer to that of the market than to the FOMC. But it really depends on how what time and how big the fiscal policy comes in on.